Imagine walking into a bank fully confident that you will walk out one step closer to securing the money you need to build your dream business. Now imagine the opposite. You walk in hopeful, only to be told your SBA loan application is denied within minutes. The crazy thing is, both people often have the same idea, the same passion, the same business plan. So why does one get approved fast while the other gets rejected almost instantly? That mystery is exactly what we are about to uncover. And once you understand it, you will never look at SBA loans the same way again. Before we dive in, let me open a loop for you. There is one factor that can boost your SBA approval odds more than anything else. It is something most beginners overlook, and it is so simple that you can fix it by the end of this video. I will tell you exactly what it is, but not until we break down the steps that lead up to it. So stay with me, because by the end of this video, you will know how to get approved for an SBA business loan fast, even if this is your first time applying. Number 1. Know what the SBA really looks for. The fastest way to get approved is simple. Think like the lender. Most beginners assume the SBA gives out money to help small businesses. That is true, but what the SBA really cares about is risk. They want proof that lending you money is a safe bet. There are 3 big things they evaluate: your creditworthiness, your ability to repay the loan, and the strength of your business plan. Here's an example. Imagine 2 people apply for the same SBA loan. Both want $100,000. One applicant has good credit, a solid repayment history, and clear financial projections. The other applicant has weak credit, late payments, and no revenue plan. Which one feels safer? The bank does not want to gamble. They want to feel confident that your business is viable. Understanding what they care about puts you miles ahead of the average beginner who walks into a bank hoping for the best without knowing what the lender is really judging. Number 2. Choose the right SBA loan program. There is no one SBA loan. There are several different programs, and choosing the wrong one can slow down your approval or get you denied.
For fast approvals, the SBA 7A loan is the most popular. It offers flexible uses, including working capital, inventory, equipment, and even buying a business. Some banks even have SBA preferred lender status, which speeds up the process because they can approve loans without waiting for extra SBA reviews. Another option is the SBA microloan program. This is great for beginners who need smaller amounts, usually up to $50,000, and want quicker turnaround times. Here's an example. A bakery owner who only needs $30,000 to buy equipment is better off applying for a microloan. But someone wanting to buy a commercial truck for a delivery business may need a 7A loan. If they choose the wrong loan type, they can waste weeks on paperwork that leads nowhere. Choosing the right loan program is like choosing the right tool for the job. Pick the wrong tool, and the entire process falls apart. Number 3. Fix your credit before you apply. This is the factor most beginners overlook, and it is often the number 1 reason SBA loan approvals are slow or denied. Banks view credit scores as your financial report card. A strong credit score tells them you handle debt responsibly. Most approved borrowers have a credit score of at least 650. Many lenders prefer around 680 or higher for fast approvals. But here is where the magic happens. You can boost your credit faster than you think. Even small improvements matter. For example, if your score is 620 because of high credit card balances, simply paying them down to under 30% utilization can increase your credit score within a few weeks. That alone can move you into approval territory. Another example, you may have a small unpaid medical bill that went to collections. Resolving it and asking the collection agency to update the status can immediately strengthen your report. The fastest approvals come from borrowers who prepare their credit before applying, not after. Number 4, build a business plan that actually impresses lenders. Most beginners hear the word business plan and think of a long, boring document filled with charts and fancy words. But SBA lenders are not impressed by fluff. They want clarity. Your business plan needs to answer one simple question: can this business repay the loan?
That means your plan should include 4 key pieces: your business overview, your target market, your financial projections, and your repayment strategy. Here is an example of how to make it strong. Instead of saying, "I expect my business to make money," Show real data. Show how many customers you expect each month. Show your pricing. Show your expenses. Show your projected profit. When lenders see realistic numbers rather than guesses, your approval chances jump quickly. Let us take a landscaping business as an example. Instead of saying, "I hope to get customers," you could say, "Our area has 12,000 single-family homes. If 1% become recurring clients, that equals to 120 customers, generating $15,000 per month in revenue." Numbers tell a believable story. A strong business plan does not need to be long. It needs to be clear, organized, and logical. Number 5. Prepare all required documents early. Most delays come from missing paperwork. If you want fast approval, gather everything before you apply. Banks love organized applicants. It makes their job easier. You'll usually need 2 to 3 years of personal tax returns, business tax returns if you already operate, profit and loss statements, bank statements, a personal financial statement, a list of business assets, and any legal documents like licenses or leases. Here's an example. If you apply for a 7A loan but do not attach your tax returns, your application can sit untouched for weeks. But if you submit a complete package on day 1, lenders can begin reviewing immediately. Imagine a restaurant owner applying for funding to expand. If they include detailed revenue records, food cost percentages, and cash flow projections, the lender can quickly understand how the business performs. That leads to faster decisions. Being prepared is the difference between waiting months and getting approved quickly. Number 6. Show that you can repay the loan. This is the heart of SBA lending. Lenders want proof that your business generates enough cash to cover loan payments comfortably. This is called cash flow coverage.
Here is a simple example. Let us say your SBA loan requires monthly payments of $1,000. The lender wants to see that your business can generate more than that each month. Ideally, they want your cash flow to be at least 1.2 times your loan payment. That means you should be bringing in at least $1,200 consistently. If your business is new and does not have financial history yet, lenders look at projections and your personal income. They want to know that you can cover payments during the early months. Another example. If a borrower has strong personal income, lenders may feel more comfortable approving a loan for a startup bakery because they know the borrower can handle payments while the business is growing. Cash flow confidence equals faster approvals. Number 7. Be ready to offer a down payment. Most SBA loans require the borrower to have some skin in the game. This usually means a down payment of around 10 to 20% for certain loans, especially when buying a business. Here's an example. If you want to buy a laundromat for $200,000, you may need to contribute $20,000 to $40,000 of your own money. Lenders want to see that you have invested in your own success. But here is where beginners often get stuck. They underestimate the amount of cash they need up front. The faster you show proof of your available funds, the faster your application moves forward. Number 8. Work with an SBA preferred lender. This step alone can cut weeks off your approval time. SBA preferred lenders are banks authorized to make final decisions on SBA loans without waiting for additional government approval. That means your loan file stays in one place instead of bouncing around. For example, Bank A is not a preferred lender. They review your file, then send it to the SBA, then wait for feedback. But Bank B is a preferred lender. They handle everything in-house. They can approve your loan much faster because no second review is required. Working with a preferred lender can be the difference between waiting 90 days and getting approved in 30. Number 9. Avoid these beginner mistakes that slow everything down. Even strong applicants get delayed when they make simple mistakes. Here are the most common ones. Submitting inconsistent financial numbers. Leaving sections of the application blank. Guessing instead of giving real numbers. Applying for the wrong loan type. And ignoring lender emails asking for more documents. Here is an example. A business owner submits revenue statements that do not match their tax returns. The lender now must investigate.
That investigation can slow the approval for weeks. Another example. A borrower claims they need $150,000, but cannot explain how that money will be used. Lenders need exact breakdowns. Without clarity, the file stalls. Avoiding mistakes keeps your file moving smoothly. Number 10. The one overlooked secret that speeds up approvals. Remember the loop I opened at the beginning of the video? Here is the answer. The fastest approvals go to borrowers who build a relationship with their lender before applying. Most beginners think lenders are just checking boxes, but in reality, lenders approve people, not papers. When you meet with a loan officer early, ask questions, show your plan, and demonstrate preparation, you move from being a stranger to being someone the lender trusts, and trust speeds everything up. Here is an example. A borrower walks into a bank cold and drops off an application. Another borrower spends 2 weeks talking with a loan officer, refining their plan, asking for feedback, and building rapport. When both applications arrive, the second borrower often gets priority. People approve people. Number 11. Understand the role of collateral. Collateral is one of the trickiest parts of SBA loans because beginners often misunderstand how it works. The SBA does not always require full collateral coverage, but lenders still want reassurance. Collateral is simply an asset the lender can take if the loan is not repaid. Here is a simple example. If you apply for a $150,000 SBA loan and you own equipment worth $50,000, the lender may still approve you even though your collateral does not equal to the full loan amount. What matters is that you have something of value tied to the business. But here is the hook most beginners miss. Lack of collateral does not automatically disqualify you. Strong cash flow, good credit, and a solid plan can outweigh collateral completely. The key is showing lenders that you understand the responsibility that comes with borrowing money. Number 12. Prove industry experience or skill. Lenders feel more confident approving borrowers who already know their industry. This does not mean you must be an expert. It means you should show that you understand the space you want to enter. For example, if you want an SBA loan to open a cleaning company, lenders love to see that you worked for a cleaning service before or managed a service-based business. If you want a loan to open a bakery, even 2 years of baking experience or a culinary course helps lenders trust you. Think about it this way. If you were lending your own money, would you give it to someone who has never worked a day in the industry they want to start a business in? Lenders think the same way. Number 13. Demonstrate personal financial stability. Many beginners think the lender only looks at their business numbers, but the truth is, lenders look closely at your personal finances too. They want to see that you manage your own money responsibly. This includes consistent income, healthy bank balances, controlled debt, and no major financial red flags. Here is an example. A borrower who earns a steady income of $60,000 per year and keeps at least a few $1,000s in savings looks responsible, but someone who overdrafts their bank account frequently looks risky, even if their business idea is strong. Your personal financial habits tell lenders whether you are reliable or unpredictable. Number 14. Use business bank statements to your advantage. Your business bank statements reveal more about your operations than you might think. Lenders want to see consistent deposits, controlled spending, and proof that the business is active and generating revenue. If your deposits jump from $0 to several $1,000s only during the month you apply for the loan, lenders will notice. They look for patterns. They want to see genuine operations, not last-minute attempts to make your business look healthy.
Here is an example. A small trucking company might show 5 consistent deposits each month for completed deliveries. That rhythm tells the lender the business is functioning, even if the revenue is modest. Consistency builds confidence. Number 15. Create a strong use of funds breakdown. One thing lenders absolutely dislike is vague requests. When applicants say something like, "I need $120,000 to grow my business," lenders immediately pause. They want details. A strong use of funds sheet breaks down exactly how the money will be spent. Equipment, inventory, renovations, marketing, payroll, operating expenses. Every dollar should have a job. For example, a barbershop owner might say $40,000 for renovations, $20,000 for equipment, $10,000 for marketing, and $5,000 for working capital. That level of clarity reassures lenders that you have a real plan and are not guessing. Number 16, show financial projections that make sense. Lenders love seeing projections, but only if they are realistic. Beginners often ruin their chances by exaggerating numbers. They claim they will make $300,000 in year one with no clear explanation. Real projections are grounded in math and industry averages. If your local fitness studio charges $50 per monthly membership and you aim to attract 100 members by month 12, that projection makes sense. If you claim 1,000 members in the first month with no marketing budget, lenders will laugh and stamp your application as high risk. Accurate projections prove you understand how the business will grow over time. Number 17, have your accountant review your documents. You do not need to be a financial expert to get approved for an SBA loan, but having someone who understands financial statements is a huge advantage. An accountant can help you prepare your profit and loss statements, clean up your books, verify your numbers, and catch errors before lenders see them. Here is an example. A business owner submits bank statements showing inconsistent numbers because their bookkeeping is messy. An accountant could have fixed that in a day. Without that cleanup, lenders may assume the business is unstable. A clean financial package leads to fast approvals.
Number 18. Respond fast when the lender asks for documents. Speed matters. Once your application is submitted, lenders often ask for more documents: tax forms, clarifications, updated statements. If you respond quickly, your file stays active. But if you take 3 or 4 days to reply, your application might move to the bottom of the pile. Here's a quick example. A borrower applying for a restaurant expansion responds to every lender email within 1 hour. The lender processes their file smoothly, and the borrower gets approved in 3 weeks. Another borrower takes 2 or 3 days to reply each time and ends up waiting 3 months. Fast communication signals professionalism and keeps your loan moving forward. Number 19. Avoid changing major details mid-application. One mistake beginners make is changing big details halfway through the process. They adjust the loan amount, they change the business location, they modify the ownership structure. Each change forces the lender to restart parts of the review. For example, if you apply for $150,000 and then decide you want $200,000, the lender must reevaluate your projections. That slows everything down. Consistency is key. Once your application starts, keep your information stable. Number 20. Understand that SBA loans take time, but you can speed them up. An SBA loan is not like applying for a credit card or a car loan. It involves layers of review: credit, cash flow, collateral, documents, projections, risk assessment. This is why many borrowers wait 30 to 90 days. But the borrowers who follow the steps in this video often get approved much faster because they prepare the pieces that matter most. Lenders reward organized, prepared, low-risk applicants. If you respect the process rewards you. You now understand the step-by-step process of how to get approved for an SBA business loan fast. You know what lenders look for, how to prepare, which mistakes to avoid, and what secret factor can boost your chances more than you ever imagined. The next question is simple. What type of business are you trying to fund with an SBA loan? And what part of the process do you want help with next?